is the core of the unit. We are on financial management, so you have to think about how to manage your finances. And one of the things that we agreed were the functions of finance manager, and one of them was capital budgeting, financial decision, risk management, and such like things, right? And even portfolio management. Now, in financing decision, we say that this is where the finance manager looks for the sources of capital. He has to think about how to get money to finance the business. So that is financing decision. One of the things that we mentioned as sources of capital for the finance manager or for the business was ordinary shares. We say that you can issue the shares, right? You don't need to start writing, or maybe if you want to do it, you can do it at the back of your book. So ordinary shares, and we said how this one works. If a business does not have money, they can issue shares to the public, which is publicly traded. You can invite the public to come and buy through something called prospectus. You send an invitation for the public to come and buy, and maybe you want to run a project that costs maybe 2 million. So you need to ask yourself, how many shares do you want to issue and at what price to give you 2 million? So this is the value of shares or share capital. This is the value of share capital that you want to add to your business. So you're going to issue shares, and let's say that you are issuing maybe 2,000 shares. So definitely, if you are issuing 2,000 shares and you want 2 million, that means that each share will be worth 1,000. So that you have 1,000 shillings per share times the number of shares that you are looking for or you are issuing, you're going to have a total of 2 million. So that is one way of getting capital. That therefore means that we shall have additional number of shareholders so that the business will be owned by more people. And now the number of shareholders will be whatever was there originally plus the new 2,000. So it means that we shall have more shares or more shareholders. Alternatively, you can raise capital through debt financing or debentures. And we say that debentures are like loans. You also issue debenture certificates, and those guys will buy and give you loans, which you pay interest as a return. Now, when we are talking about return is what you're getting back as a result of your investment. If you are doing business, your return is the profit. So if I'm doing a business and I'm invested in that business, I put up some investment, my return is the profit. For those who are giving loan, their returns are the interest. That is the return, right? So I want you to look at this particular question. We shall read it together, or we shall write it down. I want to write down an illustration and say, BD Limited. At the top, you can say illustration of financial proposal. Illustration for financial proposal. Then you write the question and say, BD Limited expects a return. BD Limited expects a return on investment, into bracket ROI. BD Limited expect a return on investment, which is written as ROI. ROI means a return on investment. BD Limited expect a return on investment, ROI, of 24% on proposed investment project. Of 24% on proposed investment projects. On proposed investment project. BD Limited expect a return on investment of 24% on proposed investment projects whose total cost is 5 million. 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 That is 24% on proposed investment projects whose total cost is 5 million. In order to finance this investment, 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 the company is considering two options. The company is considering two options. The company is considering two options. So I want you to understand what is important in this particular unit is that you understand exactly what the examiner is saying. Be able to translate. So we are saying that BD is limited. BD is just as a normal company or an individual person can also make an investment. BD Limited wants to invest somewhere. He has a proposed investment. He is making proposal. And he's now expecting a return of 24%. That is a return, that is a profit. So if I put my money somewhere, I'm expecting a profit of 24% on the investment that I put up. Therefore, if, for example, now we are being told that the cost of the project is 5 million, what do you think should be the amount of profit that he expects according to that statement? What is the amount of profit that you think he expects from this investment? The cost of investment is 5 million. What is the profit or return? In business, our returns, we call them profit. So what is the profit that you think he expects in terms of figures? Thank you so much, Denti. Finally, you've logged in well. You've logged in well. Thank you. Now you can hear us, right? Can you confirm? I've written the question. Now I've read the question, and I hope that you guys can be able to translate it and understand. 1.2 million. I was asking, thank you. I was asking, how much do you think the profit is? If you are investing 5 million and the rate of return is 24%, what is the expected profit? It is just 24% of 5 million. That is expected profit. Whenever you are doing business, you expect some return, right? So that is what you expect. Now, we have options. We are saying that for him to get the money or to invest in this business, there are two options. So in order to finance this investment, there are two options that he has to consider. Option number one, option one, issue 5 million, issue 5 million ordinary shares at par value of 10 shillings each. At par value of Kenya shillings 10 each. At par value of Kenya shillings 10 each. He is looking for the money. The money that he's looking for should be 5 million. And there are options of getting this money. One of them is to get it through ordinary shares. He can also get the money to invest through loans. That is what we agreed, all right? We say that when you want to invest, you can get money through loans, ordinary shares, preference shares. He has two options. The first one, he can issue ordinary shares that can be worth 5 million. And exactly that is what he wanted. He wanted 5 million, so he can decide to go for ordinary shares fully. How many shares are these? How many shares do you think he's going to issue? Can somebody tell me? If I want to get 5 million, no, this one is 500, sorry. The number of shares is 500. So issue 500 ordinary shares at 10 shillings each. So if one share is 10 shillings, then the 500 will be, we have 500 times 10. BD Limited shall have gotten the 5 million that they are looking for. Is that true? That is the understanding. That is the understanding. There is an option of getting 5 million by giving out the shares, 500,000 shares, and each share is 10. So the total should be 5 million Kenya shillings if all the shares were issued. Are we together up to there? Are we together up to there? So that is an alternative way of getting money. You will get the amount. Let's look at option 2. So option 1 ended here, and this is now the implication. We were just trying to demonstrate that with this information, is going to get 5 million, which is option number 1. Let's look at option 2. Option number 2 is can also get 5 million by doing what? Issue 250. Issue 250 ordinary shares at a par value of shillings 10 each, and obtain the balance through bank loan, through a bank loan, through a bank loan. It can also be debenture. They can say through bank loan or debenture. Through a bank loan or debenture at an interest rate of 15% per annum. Kindly copy that and let me know. Are we done? So we can raise the money through this option. So we are interested in getting 5 million, right? How can we get 5 million with option number 2? The first thing, we know that we are going to do 3 things. In option number 1, we were only issuing ordinary shares only. In option number 2, we are going to issue shares partially, and part of it we are going to get from loan. So we get money from ordinary shares, shareholders, and also from loan. So let's look at how that will work. So when we issue 250 ordinary shares, that is 250 ordinary shares at 10 shillings each, that will give us 250 times 10. How much are we going to collect? We are going to collect 2.5 million from ordinary shares. Is that okay? Does it make sense? The first option here was to get money purely from ordinary shares. In the second option, we can issue 250 ordinary shares, but each is 10 shillings. So how much are we going to get in terms of money? It is 250,000 times 10 shillings, which is going to give us 2.5 million purely from shares. And we need 5 million. We need 5 million. So how do we get the 5 million? We know that once we have gotten this, we still need a balance. The balance that we require is 5 billion. So you can say balance is equal to 5 million minus 2.5 million, where we are going to have a balance of 2.5 million, right? So it means that the other 2.5 million is what they are referring to. They are saying, and obtain the balance. So the balance we have seen, this is the balance that we want. How do we get the balance? Obtain the balance through a bank loan. So for us to get this balance of 2.5, we need to go for bank loan. We need to go for bank loan, and that bank loan should be 2.5. We need 2.5 bank loan. So we are going for a loan of 2.5, and the rate of interest on that loan is 15%. So we are saying that we need to go for 15% bank loan of Kenya shillings, 2.5 million. 2.5 million. That is what we are going for. We are going for 15% bank loan of 2.5 million. That is basically a statement that we have made. In both cases, listen, in both cases, we have gotten our 5 million. Option number 1, we were able to get 5 million. And if we go for option number 2, we can still get 5 million. The only difference is, in option number 2, we have taken loans as well. We have some shares together with loans. In option number 1, we only had shares purely. Now, we are told, continue writing there, down there. So in our instruction, we only had up to here. This one we have just done so that we can understand what we are doing. As you read the question, you should be able to interpret and analyze it. So in normal exam situation, you'll be given up to here. It is up to you to understand and interpret. So let's continue. They are saying that tax rate is given at 30%. Tax rate is given at 30%. The tax rate is given at 30%. Tax rate is 30%. Required, just right, required. Determine the effect of the two financing options. Determine the effect of the two financing options on the earnings available to shareholders. Determine the effect of the two financing options So we have two options of financing. The first one you have seen, option 1 and 2, determine the effect of the two financing options on the earnings available to shareholders, and hence advise the company on the best financing option. Determine the effect of the two financing options on the earnings available to shareholders, and hence advise the company on the best financing options. If you are there, let me know so that we proceed. I'll pardon. I'm saying that determine the effect of the two financing. Determine the effect of the two financing options on the earnings available to shareholders, and hence advise the company on the best financing option. So we are told that there are two questions here. Number one, they are telling you determine the effect of the options. We have option number 1, which you have written, and then option number 2. Look at their effects on the earnings available to the shareholders. Now, I want you to understand, we have returns and then we have earnings. Are we together? Returns and earnings. What we had looked at earlier were returns. That is the profit rate of return. We are able to get our profit. Now, earnings are what shareholders, not the company now. The shareholders of the company, those who own the company, will get in return. Shareholders always get dividend in return. That is the earning. What they are earning as shareholders is dividend. The company gets profit. On that profit, the company is able to pay tax. The balance, they are able to divide amongst themselves in the form of dividend. So to the shareholders, what they expect here is dividend. So that dividend can also be in terms of earning per share. Dividend per share. Now let's look at this. Why are they saying that we need to look at the impact of the two options? Because they are not the same. The first option does not have loan, the second one has loan. They are trying to ask you, if we have loan, can it affect the way we are going to have our earnings as the shareholders? So let's have solution. Solution. So we have option number 1. Option number 1. Then we have option 2. We have option number 1 and option number 2. Right? Then here, we start with getting our profit, operating profit. Which is also called earning before interest and tax. This one means earnings before interest and tax, EBIT. EBIT means earnings before interest and tax. Are we together? You can write somewhere at the top of the book. EBIT means earnings before interest and tax. That is EBIT. So it means that you need to get earnings before any deductions. It is also called operating profit. It is the total profit when you have only deducted the normal expenses. You have not deducted two things. You have not deducted interest and you have not deducted tax. But other expenses like salaries, administration expenses, transport, those things you have deducted. The only two things that are remaining that you have not deducted from this profit is the interest on loan, if you have the loan, and also the tax. And the way they come in order, it means that you first deduct interest and then you deduct tax. So you'll be deducting them in that order. You don't start by taxing before you remove the interest. You start with interest and then tax. Are we together? Now, so our earning before interest and tax, we are calculated. We say that if you invest 5 million and you expect the return to be 24%, then, or we can say that 24% of 5 million, so 24% of 5 million. What is our expected earning or return? Somebody to calculate for us. What are we getting? $1.2 million. So this one, 2.2 million, we shall get it. It is the profit. Whether you took loan or you finance it through ordinary, your investment was 5 million, so the profit does not change. Operating profit is not affected by the source of capital. Whether it is loan or you got it from your friend or your savings, that does not affect. So therefore, that profit cut across the two of them. We want to compare the two, but the profit is the same for both of them. So we have profit here, 1.2 million. And then here 1.2 million. Oh, we are together there. Now, we say that this one is profit before interest and tax. So we want to now remove interest first. We want to get net profit after tax. So you say less, the first one is interest. Less interest on loan. In option 1, did we have loans? Under option 1, did we have loan? Interest is only from the loans. Did we have loans in option number 1? We don't have loan. So you put dash because there was no loan there. In option 2, we had loans. So in option number 2, we have loan of how much? 15% of 2.5 million. How much is that? In our option number 2, we were able to calculate the amount of loan that we had to take from the bank. And the loan was 2.5. The rate was 2.5, was 15%. So we have to pay interest on that. And that is the interest that we have to deduct. So we are having 375,000. So what we are having here, we are going to have profit before tax. You call it profit before tax. It is before tax because already we have removed interest. It is only tax that is remaining. Or we call it EBT. Earning is the same as profit. So if you use the word earnings or the word profit, they are the same. So if the examiner use the word earnings or profit, it is basically the same. So this one is profit before tax, the same as EBT, that is earning before tax, or profit before tax. They mean the same thing. So our profit before tax here is going to be 1.2 because there was no interest. Here, kindly get for me the figure. Get for me this figure. Then now we less tax. Tax we are told is at 30%. Tax is at 30%. So our figure on this other side is 825,000. Now get the tax 30% of each, 30% of this. Thirty percent of this. So how much? The first one. Then 60,000. So we less 360,000 from here. What about this one? 30%. So we have profit after tax, which we call PAT or profit after tax. Earnings after tax. Can also call it earnings after tax. What do you have? $247,500. 247,500. So get me the figures here. We're going to have 40. And this one. Is it like that? I'm not very sure. Confirm. I can also use my calculator. So we have 1.2 minus 360. Yes, 840. Then here we have 825 minus 240. That is where we are. Right? Now we have profit after tax. Now, normally when we get profit after tax, this profit after tax, we normally call it profit attributable to ordinary shareholders. Attributable means it is the amount that you can now go and divide amongst the ordinary shareholders. But in practice, in normal companies, they can get this profit and then they decide on two things. Part of it can be paid as dividend. Part of it can be retained in the business to run the business. So they don't go home with everything. Therefore, whenever we have profit like this, the company has to decide, and we normally have something called dividend policy. They have to decide according to their policy, how much out of this profit should be given out as dividend and how much should be retained for running the business. Because huwezi kula kila kitu. Ukikula kila kitu, biashara haita grow. So you have to save something. You pump or draw it back to the business to run the business, right? So in normal scenario, we have to ask ourselves, is there any amount that has been allocated as retained earnings so that we know how much will be paid out as dividend? In this case, the examiner is silent. The examiner has not told us that there is any amount that should be retained. The examiner has not told us that the business is going to retain anything. We are told that how much will be earning for the ordinary shareholders. Now, listen again. We have something called total earnings. Total earnings, the same as profit after tax. It is the same as earnings after tax or profit after tax. Are you getting? Your total earnings for the business, like now this one, is the same as profit after tax or earnings after tax. It has two components. It can be divided as dividend or retained earnings. It is composed of two. So if in exams, the examiner has given you the total earnings or earning after tax, and again, in additional information, the examiner has told you that part of it was paid as dividend, then you should know the percentage that remained as retained earnings. So the examiner will tell you, maybe dividend was 40%. 40% was dividend. That means that retained earnings is how many percent? If 40% was paid as dividend, how much did they retain from the earnings after tax? %60. Thank you so much. So we know that 60% was retained. I'm doing this because this knowledge will help you in this level and in advanced level. You will need that knowledge. So it is important that you know that in total earnings, or what we call profit attributable to ordinary shareholders, that total profit can be divided into two, and you need to know which one was paid and which one is not. Now, the one that has been given out as dividend, can be dividend per share. It means that let's say that we had total amount of profit was, like in this case, we have amount of total profit as 840, right? So let's say that 840 was the profit. Then it means that 40% of this is, calculate for me 40% of this so that we know how much is paid as dividend. $366, right? So dividend will be 40% of this, which is 366. Now, this one is total dividend. It is the total dividend that the company has given out.
332.
Portion of dividend
336
wants to pay. This total dividend that the company wants to pay. Wamepata hii, wakagawana hii. This one is going to be paid amongst the shareholders. Now, assuming, Vincent, are you talking? Sorry. Assuming, now this one is the total dividend. Assuming that you know the number of shareholders. Like, for example, in the first option, we were told that we have how many shares? 500,000 shares, right? So if this is the profit that has been made, then this dividend you can divide it amongst the number of shares so that you can know how much dividend per share or each share. So let's say that we have number of shares was, number of shares is 500,000. Dividend that has been declared, the declared dividend is 366. Then we call it dividend per share, DPS. dividend for each share is, dividend per share will be, DPS will be 366 over 500. How much is the dividend per share? How much is the dividend per share? Zero point 73. True. The same way we can get dividend per share, we can also get earning per share. Now, earning per share is the total earnings all over total number of shares. So we can also say, if this is the total number of shares that we are having, number of shares, then we have total earnings is 840. Then our earnings per share, which is EPS, this one means earning per share. EPS, earning per share, is equal to the total earnings, which is 480 all over 500. How much is it? Earning per share? 0.67. Is it that one? And it 0.67. So there is something that I'm trying to derive here. We have seen earning per share, that is the total earnings, before you decide which one to go to dividend and which one to be retained. Which one to be dividend and which one to be retained. So which one is this? The first one. Make sure that we get the correct figures. Okay. So we are saying EPS is the earning per share. It is the total earnings all over total number of shares. That EPS has got two elements. Part of it is dividend per share, another one is retained earnings, also per share. So if you are talking about total, we have total earnings is made up of total dividends plus total retained earnings. If we are getting it per share, then you have total earning per share is equal to dividend per share and then the retained earnings per share. Now, what are we saying? I want you to understand that as an investor, your main aim when you are investing is the return. And to you, not as a company, to you, the return is what you're going to get in your share. When I've gone to any company like Safaricom and I bought shares from Safaricom, my worry is after buying the shares, at the end of the year, what will be my share able to give me? What will it give me? How much will I earn for each share? Not even the total number of shares that I have per share. That is what I look at. That is why for those who are having, that is why for those who have invested in SACCOs, they always, at the end of the year, you will see them asking how much dividend did they declare. It is normally dividend per share. Alafu utasikia mwingine anasema 7%, 1%, 2%. That is the percentage for the shares that you have. So it is very, very important that you know that what is important as the return is the return on each share. And that return is the total earnings. It is the earning per share. So if the examiner asks you, like now they are asking you here, that determine the effect of two financing options on the earnings. This is the earning. Determine the effect of two financing options on the earnings available to shareholders. It is the earning available for each share. So basically, he's asking you, can you tell us the earning per share that is going to the shareholders? Therefore, your comparison is in terms of EPS for each option. Let's now come back to what we are doing here so that you can understand Now that you know what DPS means, you also know what EPS means. It is easier to move ahead. So this one was option 1. So we have our total earnings here. We have our total earnings here. We can now get our earnings per share. So we say earnings per share, which is now the same as EPS. That is what investor is interested in. So EPS is total earnings all over total shares. So we can say EPS is equal to total earnings all over total number of shares. Not shareholders, shares. Total number of shares. So total earnings, EPS is equal to total earnings, which are this one, this is the total earning all over the total number of shares. For option number 1, how many shares did we have? We have 500,000. So we take our total earnings, divide by the total number of shares. Does it make sense? Do you understand something? Ama kuna mahali confuse. We are saying that we are now calculating the impact on the value of shares for each shareholder. And so for us to know the impact, we have to compare EPS here and EPS here. What will be the return on each share on these options? And that one we can get through EPS. EPS means earning per share. That is the total number of shares, the total number of earnings all over the total number of shares for each options. Because in option number 1, we have a different number of shares from that of option number 2. And even now, the profits are different because of the impact of loan, So the profits are different, and even number of shares are also different. But then our main aim is to compare the EPS so that we can know the implication. Do we understand something, or there is a confusion somewhere? Na kama kuna mahali huelewi, unasema sasa hivi. Do you understand? Sarah, tunaelewa. Annette, are we understanding? Hii inakujanga kwa mtihani. That's why I feel it is important. I repeat it. Inakujanga kwa mtihani, most likely question number 1. Do we have any challenge here? Genti, do you have any challenge here? On how you can be able to compare financing? You are understanding very well. Thank you. Now, the reason why we are comparing them is because we don't want to judge the 2 options because of the profit. Because we understand moja kati yao imekulwa kwa sababu ya interest. Imekulwa na interest. So because of that, we cannot judge them at that level. We shall only judge them with the return to the investor, and that is the earning per share for each shares. So the earning per share for each of the shares. So therefore, we have to compare that. Now here, we also have our total income here, or total earnings, all over number of shares. What is the number of shares that we have here? In option number 2. How many shares did we have? There were two ways of financing. We have 250,000. So this one you divide with 250. That is the shares that were used here. Remember, there were two options. There were two sources. One was loan. We are done with the loan. That is the implication of loan. Another one was shares. So we are looking at the shares. This one was only shares. We didn't have loan, so it is blank. We are only coming to the shares. So get me the EPS for this and EPS for this. Earning per share for the first option and the one for second option. Tell me earning per share for each. What is the EPS for this? The first option is 1.68. So we have 1.68. The second option, 2.31. If you were to invest and you've been told that there are two options, you either invest using this option or this option. Which one do you think you will go for as an investor? Utaendea gani? The one that will give you at the end of the year, the value of your shares will be 1.68 or the value of your shares will be 2.31. Which option? Option number 2. Obviously, because we have seen that the value of shares in option number 2 will be more than the value of shares in number 1. Let's look at the reason. Because it has the higher value of shares. Yes, the value of earning per share. So let's now come and analyze and understand why that happens. We are saying when you don't have loan and you majorly finance your business with the shares, it means that you're going to require a lot of shares ndio upate ile pesa unahitaji. Ndio upate ile pesa unahitaji, you'll have to use a lot of shares. Na ubaya ni kwamba at the end of the year, the profit that you'll get, those shares will all require the part of the profit. So the shareholders will want to be given a portion. It means that the more the number of shares, the lower the earning per share. Because we are saying the profit will be flooded. Profit ikikuja kidogo, kila shareholder anataka. Kwa hivyo, the value of shares itaenda chini kama mko wengi. And if you are few, the value of shares will be more. Now to investors, some investors will decide to go for loan because they know if I go for loan and go for few shares, the profit that we shall get will be divided amongst us and we are few. So we shall get more. And that is what has just happened. If we are so many, the profit that we get will be divided amongst many of us. And that means that kila mtu atapata kidogo kidogo. And that is what happened here. However, we are not saying that financing using loan is the best. This one is very risky as well. Remember what we said in our previous class? We said that loan financing or debt financing is risky. And one of the reasons that we mentioned is that once you are financed with loan, even if the business is making losses or not, you have to pay interest. Hapa hakuna option. Kama uliomba loan, ukafinance nayo biashara. The debt holder doesn't want to understand that you're making losses. Yeye anakuambia nipe pesa yangu. Hata kama umetekeleza profit or not. So for that, we say that loan financing can run the company into bankruptcy. Look at your notes. We say that if you are using loan or debentures, the risk is that the company can become broke because you are making losses na mtu bado anataka pesa. Unaenda kuomba mahali. And that is where we are as a Kenyan, as Kenyans. In Kenya, we normally finance our businesses using loan. So sometimes the government has exhausted loan from UK, the loan from US, China loan is maturing, we need to pay. Where do we run? You are going to borrow another loan to come and pay a loan. And that is a challenge. So we are doing this so that you can become a good financier or finance manager. You know the risk and the better part of it. So this one is good with the businesses that cannot run into problems. This one, Businesses are doing well, where the business is growing, revenues, you are very sure of revenues or profits, you go for this because you can afford to pay them without getting into bankruptcy. But if you are doubting, come for this, because this one, there is no shareholder who will come and tell you that pay me pesa yangu. No. If there is loss, we all suffer. We all suffer. So that is how it works. I've taken a lot of time because this one is normally examinable, and I want you to know so that you can be able to advise. So we have looked at the implication, that is through the EPS, we have looked at the implication of option 1 and 2 on the shares, and then now you advise the management. So advice, you can say, advice, you write like this, advice, then you say, option 2 is recommendable. Option 2 is recommendable. Option 2 is recommendable since it has the highest EPS. Since it has the highest EPS. Since it has the highest EPS. This one is well understood. Even those who will watch videos will understand it. Okay, so let's proceed. Now let's look at methods of issuing ordinary shares. Now you know what ordinary shares are, right? The ordinary shares. So how do you issue them? Methods of issuing ordinary shares. Methods of issuing ordinary shares. The first method is called an offer for sale. An offer for sale. So this is where, you know, so, I want you to understand something about shares. Now we have something called Nairobi Stock Exchange. Nairobi Stock Exchange is the platform where the shares are being traded. You can go and shares are also called stock, sasa, or security. Shares are also called stock or security. So you go and buy. You can go and buy shares from Safaricom. One share is trading at some amount, you buy, and then you hold it. When the value goes up, you go and sell it and make profit. So you can buy a share. Let's say that you can manage to buy even 100,000 shares, maybe at 10 shillings. You come and keep the shares. When it goes up, you go and sell it at 25 each. So you are going to make a profit of 15. 15 shillings times 100,000. How much is that? That is a good amount of money. Still, now, there are companies that are doing this. They are called brokerage companies or investment banks. They can do this on your behalf. They will assist you buy. Of course, you pay them commission. That is their income and that is their business. So they will assist you buy. After buying, they will call you when the shares are up and tell you, oh, Mr. Dennis, we want to sell your shares. They are now doing well in the market and we expect the shares to go down in the future. So this is the right time to sell, because if we go beyond this date, you are going to lose. Then I'll give them go ahead to go and sell. They make profit and give me some money, and then they buy a new share again that they think will make profit in the future. That is what they do. Now, because of that, when a company wants to go and buy shares, Where they are trading is called capital market, but the platform is called Nairobi Stock Exchange or Nairobi Securities Exchange. But the market is called capital market. Now, capital market, which is called CMA, CMA is the regulator. This one is called Capital Market Authority. It is a regulator that regulates the capital market. Capital market is where shares, bonds are being traded for a longer period. When you want to buy something and you hold it for a longer period, you go to capital market. That is where shares are traded for a longer period. If it is a shorter period, you don't call it capital market. You call it money market. So money market are where securities are traded for a shorter period. Those are two markets that you need to understand. We have money market for a short period security, where you can go and buy today, after some few days you go and sell. That is called money market. But capital market for a longer period. The two must be differentiated because the investors want to know. They have a project that wants to go for 10 years. Where can they get money? They go to capital market. That is where they can get loan or shares that can be used for 10 years. That is a longer period. But a short period like 2 months, less than a year, that is a short period. You go for money market, where you go and buy, sell. There, you trade or you buy shares, which you think you can sell anytime when you need the money. So that after 2 months, if you need the money, just walk in and say, I need to sell my shares and get my money back. I want to buy something else. That is called money market. Now, companies are there, which we call them issuing houses. Issuing houses. So if personally, I'm not known in the market, mimi sijajulikana sana kwa hii biashara. Tunaelewana? So that nikienda kwa market, maybe sitapata watu kununua my shares. Remember, shares are certificate. I need money to run the business. I've started a new business, probably like NTC. But if I go now to Nairobi Stock Exchange, NSE, to buy shares and tell people, come and give me money and take certificates so that you become part of NTC, people will not do that. They will not do that because NTC is not popular. So such unpopular companies have problems trading. They will not get people to come and buy. What they can do, they can go to issuing houses and sell their entire shares to these guys. It is now up to these guys, because they are known, they are popular, they can now go and sell the same shares to other people. And people will buy them because wanawaamini. They believe in these guys. They know them. They believe in them. So they can buy from them, but they cannot buy from me. So my safest thing, I'll go and sell to them, maybe at 10 shillings each. And then they are going to take it and sell to the public at 15. They make a profit of 5 because they are in the business. We call them issuing companies or housing. So any company that is not popular can go and sell to them, and then they sell to another person. That is what we call an offer for sale. You sell to somebody who is popular, let him go and struggle to look for the market, because with him is known. So I want to write that an offer for sale involves the issuing company. It involves the issuing company, that is the company that is issuing shares for the first time. It involves the issuing company selling the entire issue or shares to an issuing house. It involves the issuing company. He is giving an offer. Take a 10 bob. Wendo pamane na hali yako. I can allow you to take, it is an offer. Because he knows that he cannot sell if he's going there alone. So it involves the issuing company selling the entire issue to an issuing house, which then publishes the offer, which act as the prospectors. which then publishes the offer, which act as prospectus. Did we understand that? Can you explain that in exam? If you are told that define the following terms, an offer for sale, can you explain that this is where an issuing company sells the entire issue or shares to an issue house, which then now sells to the public as a prospectus. A prospectus is a document that is prepared to attract people to come and buy. So check your notes if you've written the correct thing. That issuing company sells the entire issue to an issuing house, which then publishes the offer, which act as the prospectus. The shares are offered to the public at a fixed price, which is above the original price. The shares are offered to the public. The shares are offered to the public at a fixed price. The shares are offered to the public at a fixed price. The shares are offered to the public at a fixed price. The shares are offered to the public at a fixed price, which is higher than the original price. Which is higher than the original price. It is higher than the original price. Wow. Let's now look at the second method. The second method of issuing shares is called issue by company. Issue by company. Issue by company. It is normally done by large companies, the very known companies, popular companies. They can go and issue directly to the market. So you say, issue by company, you say, this method is used by large, well-known companies. It is used by large, well-known companies. It is used by large and well-known companies. It is issued by large and well-known companies. They issue prospectus, which invites the public to subscribe to its shares. I said that prospectus are like invitation. It is a document that you prepare to give to the people. It will show even the financial performance, so that when you're telling somebody, come and buy my shares, he's able to see how you are doing well. It is normally signed even by the auditors, the prospectus. So we can give that prospectus to people in the public. They look at it and they get convinced to come and buy our shares. If somebody lies akidanganya kwa hiyo prospectus, it means that you're going to attract people to come and buy vitu za uongo. So we are saying that the company issue a prospectus or prospectus. The spelling is like this, prospectus. The company issues a prospectus which legally invites the public to subscribe to its shares. That is called issue by company. So the companies that are very known, they can use that method. Number 3, we call it placing. So number 2 was issue by company. Number 3 is called placing. Placing. So under placing, we have 2 types. You say that there are 2 types of placing. The first one is called private placing. Private placing is a situation where a company is a situation where a company buys It is a situation where a company buys shares or stocks that are not listed on the stock exchange. They buy shares privately that are not listed in the stock exchange. That is why it is called private. So I know that Safaricom wants to sell some shares. I don't wait to go and check when they are trading in the stock exchange. I just go to Safaricom and buy privately. So private is where placing is where the company goes and buy shares that are not listed in the stock exchange. They buy shares which are not listed on any stock exchange. This method is used by unquoted companies. This method is used by unquoted companies. This method is used by unquoted companies who require small amount of money or a small amount of capital. So they don't need to go. When you are trading in stock exchange, that is when we say you are quoted. Kiona kampuni, after every news, unaona wanasema Diamond Trust Fund shares were trading at this. Those are quoted companies. They are quoted in the stock exchange. So if a company wants small amount of money, they don't see the need of going there to look for money. They can look for their friends or inform some friends to come and buy privately. So we are saying that this method is used by unquoted companies who require small amount of capital. It is used by unquoted companies. It is used by unquoted companies who require small amount of capital. The second one, under placing, or you can call it B, under placing, is called stock exchange placing. Stock exchange placing. Stock exchange placing. So under stock exchange placing, you can say this is where a company places the issue. It is where a company places the issue. A company places the issue. A company places the issue with a stock exchange firm. With a stock exchange firm. A company places the issue with a stock exchange firm. With a stock exchange firm. Let's now look at number 4. That was number 3, which was placing. Number 4 is called stock exchange introduction. Stock exchange introduction. Stock exchange introduction. Stock exchange introduction. You say that this is the issue of shares. This is the issue of shares through the stock exchange by quoted companies. It is the issue of shares through the stock exchange by quoted companies. The issue of shares through stock exchange by quoted companies, full stop. The company is required to advertise widely. The company is required to advertise widely. The company is required to advertise widely. The companies are required to advertise widely in order to attract the general public to subscribe to its shares. In order to attract the general public to subscribe to its shares. In order to attract the general public to subscribe to its shares. The company is required to advertise widely in order to attract the general public. In order to attract the general public to subscribe to its shares. Number 5 is called right issue. Rights issue. Rights issue. You say this is where it is where existing shareholders are allowed to acquire more shares. It is where existing shareholders are allowed to acquire more shares. This is where the existing shareholders are allowed to acquire more shares proportionately with their current shareholdings. Proportionately with their current shareholding. This is where the existing shareholders are allowed to acquire more shares proportionately, with their current shareholdings without incurring brokerage fee. Without incurring brokerage fee. Without incurring brokerage fee. This is where existing shareholders are allowed to acquire more shares proportionately with their current shareholdings, without incurring brokerage fee. So what do we understand by right issue? Assuming that we are currently the shareholders of ABC Limited. So we have a company called ABC Limited, and we are the current shareholders of ABC Limited. Then we realize that ABC Limited requires some money. We are going to be given the priority to buy the shares instead of going to the market. What fee? Brokerage. Without incurring brokerage fee. Brokerage fee. So I'm saying that instead of them going to the market to acquire shares, to acquire some money, they can tell their existing shareholders that, guys, we need more shares. Can you come and buy? So the existing ones are going to buy. That is why we are calling it right issue. They are given the rights, the priority rights to buy. So it is bought in terms of the proportion of your shares. So if the total shares were 100,000, and they need additional 10,000, then they will come to each shareholder. They ask them, how much shares do you have? So personally, I have maybe 5,000. So come on, on 5,000, I'll begin 5 over the total number of shares times the new one that we want. We want 10. So I'm only allowed to take that. I can only take 500 shares because it is in proportion to what I owe, what I have at the moment. So what are the benefits of this? Say benefits of right issue. It is cheaper than a public share issue. That is a benefit. It is cheaper. It is cheaper than a right share issue, that the public. It is cheaper than. It is cheaper than a public share issue. Number 2, it rarely fails. It is not easy for you to fail. You know, you can go and issue shares in the market, people refuse to buy. But this one we are saying is not easy to fail. It rarely fails. It rarely fails. It rarely fails. The next one, it is issued or it is made at the discretion of directors. It is made at the discretion of the directors. It is made at the discretion. Discretion of directors. It is made at the discretion of directors. The next one, equity stakes are not diluted. Equity stakes are not diluted. They don't bring many shareholders. So the existing one peke yake, therefore it is not diluted. Equity stakes are not diluted. Let's look at bonus issue, which is the last one. Bonus issue. Bonus issue. Bonus issue. Bonus issue. It is where the company issue more shares to its shareholders. It is where the company issues more shares to its shareholders. It is where the company issues more shares to its shareholders. It is where the company issues more shares to its shareholders from its retained earnings, where the company issues more shares to its shareholders from its retained earnings. From its retained earnings. From its retained earnings. in proportion to their current holdings. From its retained earnings in proportion to their current holdings. It is where the company issues more shares to its shareholders from its retained earnings in proportion to their current holdings. So, this is where you are given more. If you have like 10 shares, you can be given extra without paying. It is called bonus shares. You are given more shares extra without paying. It's called bonus shares. So instead of paying so that you can give capital, they do what? They use the retained earnings. Normally, if you have like 10,000 shares, you must have paid for it. If you have 10,000 shares, you must have paid for it, and that amount is called share capital. It goes to the share capital account. But when you are given free shares, additional 5 shares, there is no money that you are paying. They have now to go and hit their retained earnings. They are going to use the retained earnings instead because there is no additional money that has come in share capital account. So they use retained earnings. And that is why I mentioned that from its retained earnings in proportion to their current holdings. So let's stop there. The last part is a question, some small calculation, which we cannot do now because of time. And there are a lot of rain outside here, so I have to shout. So we cannot do it now. It can take 30 minutes. So that we move to topic 3. We shall move to topic 3. Topic 3 is the last part of theories. The rest will now be calculation. Topic 3 is the last part of theories, which is financial institution. Unless there is question, I request that I stop from there. Or I stop there. If you have any question, you can let me know. I've shared something on your WhatsApp. Kindly take those few notes. We shall continue from there. So it is important that you copy them. Like that part where we have consideration on issues of shares and computation, where you have S, P, N. Write them down because we are going to use them in our next class. We are going to take like 15 minutes or 20, and we should be done with the calculation. We start topic number 3 in our next class. Thank you so much. You're saying the class was well understood. Thank you so much. Kindly repeat the last point of advantage of I've shared that. Look at what I've shared. You are going to see them there. Any other question? Did you say profit after tax equal to total earnings? Yes. Profit after tax is the same as the total earnings or earnings after tax. So it is also the same as profit attributable to ordinary shareholders. Profit attributable to ordinary shareholders. It is the same. Thank you so much.